Alright, good afternoon, world. Hello, traders. Just fix something here. Alright, I'm an associated member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. Can more people say good afternoon so I don't have to see Josh's meme anymore? All my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. There is the position disclosure. It's basically unchanged. A couple day trades and a couple names, but didn't keep them. All right, let's jump in and talk about today. Very quiet session. I mean, you can already see I've got my daily chart here. Look how tight the range is on the SPY candle. Just so quiet. When I did the morning meeting today, I remember seeing that we were up 0.22% as I was starting the morning meeting. And here we are starting the afternoon meeting, and we are up 0.22%. So, kind of tells you how things went today. Pretty quiet. Qs, when I started the morning meeting, I think we're up 0.2%, and they closed up 0.09. And the IWM was relatively weak. I think it was relatively weak pre-market also, closing down 0.36%. Again, popping over to the daily chart, which I currently have up, just look how tight this candle is range-wise today. We had a $2 range in the SPYs. Very, very tight. One of the tighter ranges. Just eyeballing the daily chart here, this looks like the tightest range we've had since we peaked in July. Wow. Qs, same deal. Very, very tight day. Nothing really to talk about. IWM, a little bit wider of a trading session because of its relative weakness. The Russell did not trade well again today. Overall, though, time continues to be bullish. I still feel like we've got fairly mixed signals as far as my thought process goes with this market. But whenever I feel mixed about the market, I always just turn to the technicals for confirmation. And as I said in the morning meeting, and as I'll say again right now, the technicals are bullish. The technicals are bullish as long as we continue to hold above 565 in the SPYs. And because of the ex-dividend on Friday, it's really more like 563.25 to 565. The technicals are bullish. And not only are the technicals bullish, but a day like today, a very quiet day, is also bullish because it just allows those moving averages to catch up a little bit further, and that applies more upside pressure to the market. Yet, we didn't actually break out and go and give any further confirmation. But as long as we continue to hold above our key levels for the market, there just becomes an increasing probability that we break higher. So it's pretty much where we're at. We are at a spot here with this market where rest and time is bullish, and we will see if that leads to continuation. So far, so good for the bulls, despite us starting our 2 weeks after the September Opex period, which traditionally is a weaker period of time. There are certainly reasons out there to believe that this time could be different, just because of the bigger corrections that we had in August and September, and the fact that those corrections in August and September washed out a lot of positioning. So if we're able to break higher, then that means that there is more money on the sidelines that could come in and chase. And I guess if we were to break lower, there's less stock out there that people are long to be able to puke out. Which doesn't mean that we can't go lower, because I do also think that we're in an environment here where liquidity is still a little bit low. There's a corporate buyback blackout window that's ongoing right now. So it's not impossible for us to break lower and then see momentum lower. That's actually kind of been my base case assumption, is whichever way this market goes, it'll go with some degree of continuation. So if you're seeing that we're having a real trending type of session, don't be overly mean reverting as far as your trading goes. But the flip side is, on a very, very quiet day like today when nothing's going on, you can look to work ranges. And that's pretty much all I did today. I just kind of worked the ranges a little bit in the swing positions that I already have on. I worked some ranges in my TQQ position, in my NVIDIA position. There was a time I took a couple day trades. I shorted a little bit of Apple off those highs. It was just kind of a little bit of a scalpy type of day trade. I traded a little bit of this KAVL, which was just, you know, a up 200% insane stock of the day, just to try to create a little bit of cash flow for myself. Picked my spots in Tesla to short this upside extension somewhat aggressively. Not super aggressively, a little bit, but fully covered that by the time the market touched the 80 MA and then got out of the way. This is the strongest stock in the market. I have been short this thing since September 18th from like, you know, $230. It's now at $250, and I'm actually still in the money on my short. And I've called out two different longs in the stock. I called out the 230 long 2 trading sessions ago, and today I called for the inside and up for continuation in Tesla. Both those trades worked great for anybody who wanted to take them long. Yet, because I was short with a strong profit cushion on the 18th and kept it a little bit, I just, you know, I've kind of, I don't like saying trading my P&L, but I think you guys know that a lot of times what I do with some of my trades is I'm willing to give back everything that I've made for the opportunity to potentially make more. That's kind of been my thought process with Tesla, is like, all right, you know, I made some good money here on the 18th, and I'm willing to give back everything that I've made. And just by kind of picking my spots and get heavier in the right places, and by not being too greedy on pullbacks, here we are at $250, and I'm still able to be positive, albeit in a pretty small way at this point, on my Tesla short, and I'm sticking with it and hoping that the upside extension just causes the stock to take a pause or pull back at a certain point, which could pay me a little bit further. But if we really clear up on a day 2 tomorrow, I'll probably have to stop myself out on this thing. That's been working pretty well. My NVIDIA short I'm still in, which I like much better than my Tesla short. It's ran into that 120 resistance. It's been one of the weaker names that's been out there. We're looking at 115 on the downside today to see if it could break to get some follow through. And it ticked a little bit below that today because it was a weak stock, but didn't give any follow through, as this market just is doing absolutely nothing. So that kind of sums up my trading day, at least. Best calls of the day, I think, were the Tesla long from the morning meeting for the inside and up, though it did actually require a decently large amount of risk. If you wanted to take that trade, you had to risk about $2 in it, which, you know, a little too much for me personally. And the SMCI, which Josh actually mentioned, he's surprised in the morning meeting that he's surprised the stock wasn't lower based on some news that came out on Friday afternoon. But, you know, we remarked 2 things. One is that when there is something negative out there that should bring a stock, in this case, down, and it's not down, sometimes it's a signal for the other side. And also that if this consolidation could break up, it could be a decent long. So those are probably the trades of the day. It was opening drive in SMCI and the opening drive in Tesla. Outside of that, very, very boring trading session. Very, very tight range. Surprisingly tight for the first day after Opex. I know that we rolled off a bunch of Gamma, but Gamma's still positive, and Bill had made a note for us in the morning pre-market today to let us know that it's not necessarily the typical like unquenched post Opex that can really release the bigger moves, but I still am somewhat surprised at just the degree of how tight things were. But I think we were able to recognize it pretty quick intraday. Early on in the day, in that first half hour, this price action was very sloppy and choppy and weird, I think is the right word. We noticed it. So for me, that was like, all right, I see no reason to push things. I remember looking at the Qs, and it was one of those days where it's like I remember at 10:05, it's like, all right, Qs look like they're going to break out to new highs and get above Friday's high and go. And then 5 minutes later, they're like testing the 21 EMA and getting below it. And it's like, all right, the cues look like they're ready to break down and break out of this pattern and go lower. And then 10 minutes later, they're making new highs in the day, and it's like, oh, okay, here we go. They're ready to break out and go. And then 15 minutes after that, we were trading below the 21 EMA on a closing basis. This 80 EMA looks like it's starting to point down, maybe even going to roll over. Oh my God, we're about to break down again. And then it's followed by a positive Maribosi on the 5 minute that brings us right back to highs. Just a very choppy, sloppy, weird trading session, but we recognized it early enough to say, hey, probably don't push buying the breakouts here or shorting the breakdowns because it doesn't seem like we're getting any actual follow through or anything. So that's pretty much all that I've got. I'm happy to answer any questions anybody has. Starting with Tate in the VTF, he was asking me a question that he had to run, so I'm sure he'll catch it in the YouTube later. But asking about using SMMT to ask a general question on kind of technical analysis of the moving averages. So he says, hey Derrick, when looking at SMMT pre-market, what turned me away, and I think we mentioned this one in the morning meeting, what turned me away was the wide gap between the 8 and 21 EMA. Because you were originally thinking like a long, I think, like a long back through or something like that. I forget exactly, but I remember you mentioning a potential long here. I'm glad I didn't take it since it ended up being an inside and down. When we say the large space between the EMAs indicates the stock is still extended, I'm curious how you gauge that and determine when it means the stock is indeed overextended, even when it's sitting on the 80 EMA. Sure. So great question. So to summarize the question, as I think everyone knows who's been working with me for a while, the way that I view extension, or probably the better way to say it is the way that I view equilibrium, technical equilibrium in the market for any stock or any market, is basically the space between the 8 and 21 EMA. So when you have a stock that's moving higher or trending higher, the 80 EMA is going to be above the 21 EMA. When you have a stock that's moving lower, the 80 EMA is going to generally be below the 21 EMA. So in this case with the SMMT, the stock had a big upside move. It's been trading higher. The 80 EMA is above the 21 EMA. The stock worked its way all the way up to about $34. The 80 EMA was down at $24 still at that time, slightly under even when it was at 34. So you had $10 worth of extension from where the stock was trading at highs versus where the 80 EMA is. Now, extension is relative, right? Stocks that are higher beta or momentum-based names can get a lot more extension than typically an index or like a consumer staple. So not, every degree of extension is going to be the same for every single stock. Stocks can also become significantly more extended if there is a news event or a technical momentum event that can create much more extension than there would be otherwise. So there's no, general rule that you can say that a stock is 3% or whatever percent away from its 80 EMA, therefore it's too extended and I should be looking the other way. You almost need to know each stock well enough to be able to gauge what counts as a large degree of extension for that stock or not. Because we trade and look at the indexes so often, we have a good feel, I think, for, SPYs and Qs. When it's $10 plus of extension, we generally consider that to be getting into the extreme extension territory. If the IWM, it's more like 7. So we talk about that a lot. But there's another factor that you want to realize, which is that when you get those momentum moves, so we always talk about this 80 EMA mainly because the 80 EMA is the upper band of equilibrium. So a lot of times I'm measuring the extension to the 80 EMA, I'm measuring the extension to the 80 EMA. But the 21 EMA in a stock that's moving higher is going to be that lower band of equilibrium. And again, the space between the 8 and 21 EMA is going to be our general equilibrium. So in a stock, if you look at this SMMT from June through August, when it's moving a bit but not going too crazy, there's not a massively wide spread between the 8 and 21 EMA. The stock is moving higher. The 80 EMA is above the 21, but the spread is, relatively narrow. Then you get a really, really big fast move like this, that spread between the 8 and 21 EMA widens. So what that means is if you get a pullback to the ADMA, I don't know, like in August here, it got on August 23rd, it got slightly extended away from the, and you know, it got actually almost $1.75 away from the ADMA, and it was like $2.85 away from the 21 EMA. You know, so you get the pullback to the ADMA. There's not a lot more space to get down to the lower band of equilibrium. They're relatively tight, that equilibrium zone. When you get a really big fast move like this, and then you pull back to the ADMA, those moving averages spread out a little bit, so the equilibrium is much further. So again, like just going back to that August 23rd date, the ADMA is at $12.50, the 21 EMA is at $11.40. So there's a $1.10 spread from this up move that it had between the 8 and 21 EMA, which widened from almost touching each other back here on August 7th. But then you get such a massive move here where the stock goes from $12 to $34 over the course of 5 trading sessions. ADMA shoots higher, so by the high here on the day in which highs come in on September 16th, the ADMA is trading at about $24, while the 21 EMA is at a little bit above 18. So you've got approximately a $6 spread between the 8 and 21 EMA compared to the last move that the stock had, where it peaked out on a decent, what seems like a decent amount of extension, couple dollars of extension. The spread between those moving averages was just over $1. Here the spread between those moving averages is $6. So sometimes what happens when you get those really, really big moves, and I'm just explaining this to lay a basis to even be able to answer Tate's question. When you get those really, really big moves and that lower band of equilibrium is so far beneath the upper band of equilibrium, sometimes just a pullback to the ADMA is not going to be enough. Sometimes it is. If there's a lot of momentum and a lot of strength, even in this type of extension and spread between the 8 and 21 EMA, if there's a lot of strength and momentum, you can still just get the fast pullback to the ADMA, and then momentum resumes and you're very quickly seeing a new high. That can happen. But a lot of other times when that spread widens out so much, you need a deeper actual correction from the stock, a deeper correction through time to allow this 21 EMA to catch up, to then tighten the spread up between the 8 and 21 EMA again, or through price where sometimes you get a move more to the midpoint of the space between the 8 EMA or even 8 and 21, or even you get down to the 21 itself. So, circling back to Tate's question, Tate's basically like, hey, I was thinking about buying SMMT today, but I decided not to because the spread between the 8 and 21 EMA was so wide that I felt that this thing, needed a deeper time or price correction to satisfy this 21 EMA, this lower band of equilibrium a little bit further, that my trade wouldn't work. So it's a, pretty educated thought process, I think, there from Tate. And then the question is, how do you gauge that? How do you gauge that wider spread between the 8 and 21 EMA when you are thinking about your decision making? And the truth of the matter is, for me personally, I don't have a specific rule for it. I don't, maybe I should. Maybe we just discovered a flaw in my trading, because like I always say, you should probably have a rule for everything in trading. But I don't, at least at this time, have a specific rule for treating stocks where that spread between the 8 and 21 EMA has widened out necessarily different than I treat other things. But it's absolutely something I take note of. I am, especially at the index level, when we get a really big index move, I'm always extra cautious on that retracement to the ADMA, that it's not going to be as simple as a, quick tick of the ADMA upside tail trend continuation. I'm much more cautious in those situations. So generally when I see that wider spread, I'm going to be more cautious as well, and I'm not just immediately looking to buy it on the 18th here on the first day that it touches the ADMA. Again, maybe sometimes if you get a really strong high volume pivot there that's really indicating momentum continuation, but most of the time not. But again, to directly answer your question, I don't have a direct rule for it. It's just something that I take note of, and add to my thought process or my layers of probability, I guess I should say, when I'm thinking about putting on a trade in the exact same way that you did. You're thinking about putting this trade on maybe for your inside and up, probably an SMMT, but said, you know what, there's a large spread here. The 21 EMA is still very far down. I'm going to be patient on this. I'm going to let some of this broader, bigger time frame extension satisfy itself before I look to get aggressive on buying it. And I kind of do the same thing. So again, for me, I don't have a rule. Maybe I should. It's just kind of something I build into my thought process from a probability perspective. So I appreciate the question, Tate. It's a really good question. Popping over to the YouTube. Uvixi Bull asking about Palantir. I ran out of stock in Palantir. Nice. It's up a lot. I've been involved in the long side of this thing in one way or another for over 2 years. Do you ever do anything with trades that have lasted a while different to get back in? Sure. So great question. So Palantir is actually one that I've traded to the long side for a long time myself. I don't have a position in it currently. It's gone up just a little bit too much for me, which I think might be a similar thought process to you. So when I fully liquidate a position in a similar situation as to what you're describing, I've traded it to that long side as a swing trade where I'm day trading around a core position for a long period of time. My idea works great. I eventually get the big move and I eventually get to my targets or whatever where I run out of stock. Now I'm flat, right? So when I'm in the trade and I have a game plan, I want to remind that I'm a stickler to the rules of the game plan because it's the rules that breed consistency, which breed consistent profitability. But now I'm out of the trade. So I can now take the time to fully reassess. What do I want to do with this trade? Do I want to be aggressive in getting back in? Do I think it's gotten too expensive here where I would want to only be involved in a much deeper pullback? Or am I even done with this name entirely and completely, which sometimes happens as well. But basically, I probably break it down to 3 different decisions. Decision number 1 is, hey, you know what? I still like the stock a lot. I still think that there's room for this thing to continue to go higher. So I am going to get out of the position per my target, but I will look to re-enter and start a new, probably small feeler rebuy position on the touch of equilibrium, on the 80 EMA or maybe a little bit below the 80 EMA on the daily chart on a touch. And now build a new game plan around that, but sometimes when I do that, I'm also implementing the positive P&L that I've already made in the trade for kind of carrying that P&L forward to continue to be able to trade it. That's one thing that I do. Another thing that I might do, and this is exactly what I'm personally doing with Palantir, is I might say to myself, hey, you know what? I like Palantir a lot. It's been a fantastic run, but I personally think that the stock is just getting a little bit expensive for me. I'm interested in being involved in Palantir, but I'm only interested in being involved in Palantir on a much larger dip. Much larger dip to where? I'm not entirely certain. I'll take that as it comes. But I'm not going to just be simply buying this back down to on the 80 EMA. Which again, maybe that's cost me a little bit of money. As a matter of fact, it definitely has, because I have not been aggressive in getting back into this thing, and now it's at $38, and I've been out of it since, I'm not exactly sure, since low 30s or so. So I've missed the last leg of the move, but that's just my, fundamental viewpoint and thought process for Palantir. It's been one of the strongest, if not the strongest, of like all the general growth stocks that have been out there, where it's not been a great year for a lot of other, somewhat similar companies. But at this point, and I did actually check this a little bit over a week ago, and it's even higher now. But a little bit over a week ago, I was just doing some research specifically on Palantir because I was trying to decide how aggressive I want to be and potentially getting back into it because I do like the story. But I think I saw that it was trading about at an 85 forward PE multiple, which I just felt was a little bit rich. And then actually, I think it was this morning. If it wasn't this morning, it was on Friday morning. I'm trying to scroll up in the VTF to see, but it was all the way from the pre-market, so it might take me a while to find it. A sell-side analyst, and of course, sell-side analysts, I don't always trust them, and I want to take everything that they say with a grain of salt. But one of the sell-side analysts, I think downgraded or lowered their price target on Palantir. I don't think it was an official downgrade. It might have been like a price target reduction or something, or some sort of reiteration. Oh, here it is. It was a downgrade. Wow, and the stock was able to do what it did today on a downgrade. It's very impressive. But it was Raymond James, and the analyst comments actually specifically echo what my personal thought process is in Palantir, where I still like the stock, I still like the story, but I'm not in a rush to get in aggressively without a much bigger dip. So the analyst commentary, I'll read it out loud because I have it in front of me here. Again, this is Raymond James downgrades Palantir to market perform from outperform. So basically a neutral now instead of a buy. Similar to my thought process. While we remain enthusiastic about Palantir's long-term positioning in AI, we are downgrading our rating to market perform from outperform, as we believe shares need to consolidate after stellar gains and grow into their rich valuation. Palantir shares have appreciated over 120% year to date and around sixfold over 2 years, compared to 20% and 50% for the S&P. Valuation has expanded approximately fivefold, making it the richest software name among comparables at 26.1 times forward 25 sales, fiscal year 25 sales. The S&P 500 inclusion announcement on September 9th catalyzed a 23% move in the last 14 days, leaving significant positive estimate revisions as the lone catalyst from here. That comes from Brian Gessular at Raymond James. So it was interesting to see that thought process, because that's my exact same personal thought process on Palantir here as well. So again, now to directly answer your question, option number one, I can be really aggressive, just get right back into kind of a new trade on a pullback to the ADMA. Option number two, which is what I'm thinking for Palantir, as I'm taking a little bit of a step back from the stock. I still like the story, but the valuation's a little bit rich for me, especially after this big move. I would probably look at this on a pullback to 33. Something like that is a price I might be interested in. Even there, the valuation's a little bit rich, but I got a big P&L cushion, and I like the story, so I might be interested in trying it at that level. That's option two. Or option three, like I did in Coursera some time ago now, was I said, I think that this, I just don't want to be involved in this anymore. I caught this, move in Coursera up to $20, which or so. I think 19 or 20, something like that was my target. I got out of the position entirely. This is in 2023, and I said, I'm worried about the story here for this Coursera, that things have changed. I'm not interested in the way that I was, and I just kind of took the name entirely off my watch list, which is obviously prudent, considering what the stock has done since then. Pretty nasty. So those are kind of the three things I consider doing. Appreciate the question from Vixie Bull on YouTube. Next is from Kevin G. Is there any way we can recognize chop before we're an hour into the market and getting sliced? These days are always the worst for my P&L. Sure, it's a fantastic question. You can never know for sure. But there are things that we look at every morning. It's part of my research process to try to get an idea and estimate what type of day today will be. Is today more likely to be a trend day, or is today more likely to be a range day, because the strategies that you implement for trend days versus range days should be different, and generally trend days have much more profit opportunity than range days do. And we also know that while we prefer the trend days, most days are range days. I don't know an exact statistic, but if I had to kind of guesstimate, I would guesstimate that 20% of trading sessions, so 1 in 5, maybe it's a little bit better than this, but I'm going to guesstimate 1 in 5 days end up being range days. Maybe it's a little bit better than that, but I'm going to stick with that. 1 in 5 days are trend days, and 4 in 5 days are range days. So more times than not, it's actually going to be a choppy range day than it is going to be a trend or momentum continuation day. So then the question then becomes, all right, well, what creates trend days? What creates continuation momentum days? And it's typically News and or technicals are what create those. So that's why I want to know, are we having a breakout that could be a technical catalyst for a trend day instead of a range day? Or is there a new, news event with the Fed or whatever that can also catalyze a trend day? So those are the questions I'm asking myself. And again, the default is that it's probably not going to be. The final thing to really consider, though, is the market dynamics, right? We know that in the lower likelihood event that we're trading in like a negative gamma environment, that you then have a much higher probability of a trend day. Whereas if you are trading at, $10 billion plus of positive gamma, it becomes a much, much lower probability of becoming a trend day. So those are the main things that I would be looking at and asking myself is there a catalyst that can create trend or momentum today, either technically or fundamentally? And also, are the market dynamics such that they make it easier or more difficult for this market to be a trend or range day? Now, coming into today was a very quiet, choppy, super tight range day, but I could see you having the belief that today has the capacity to be more of a trend day because we just got through Opex on Friday. And oftentimes, though this Opex, I guess, it's not that different because we still did run off on some positive gamma, but it's not a massive change either. But anyway, a lot of the times options expiration causes a lot of that positive gamma to roll off, and then immediately after Opex, you then have a higher probability of having a trend day. And on top of that, we just recently, on Thursday of last week, broke out to new all-time highs for the market. So if you can combine like that technical breakout being set up for continuation with the fact that Opex just rolled off, I could easily see having the idea that today could be a trend continuation day. And as a matter of fact, for me personally, I thought that there was a higher probability that we were going to get a bigger move today, either to the upside or to the downside. And then that didn't happen at all. So sometimes, you go in with a thought process and a thesis based on your research, and then the market proves you otherwise. And that was really more today's trading session. But it didn't get me caught up just because I was able to recognize very quickly that this price action was looking pretty sloppy and choppy, and I took a step back from looking for continuation and actually worked some ranges today profitably. So, great question, Kevin. Really great question. Hope that helps. From Ian in the VTF, why is the average volume so relatively low historically on the SPY? The first half of the year had much higher average volume. Yeah, so just kind of eyeballing it here, it certainly looked like the first half of the year had higher volume. I can tell you that it is very typical for the summer trading session, July, August, and at least the first half of September, to trade on lower volume than the rest of the year. So that seems like it happened again this year. We did see a drop off, it looks like starting in May on the volume that mainly continued throughout the summer outside the volatility scare that we had in August. Outside of that, I don't directly know. So there's definitely a little bit of a seasonality effect, but otherwise I don't directly know. I mean, it has seemed like, and our numbers have shown that we've been in a little bit of a lower liquidity environment generally, so that could give way to some lower volume as well. But the bottom line is I don't fully know. If that doesn't build back up in October, as we're getting through the summer session, then I really don't know. But I would also say it might not matter. I just remember there are points in time in my trading career, 2013 always comes to mind, where in 2013 the S&P was up like 32-33% on the year. And everyone was complaining all year that it can't possibly be a real move because the volume is so low and the volume confirmation is not there. Volume is just that. Volume is confirmation. Volume is not necessary for moves. It's not necessary for moves, but it confirms those moves as we actually see them. So it's something to note, but I don't think it's necessarily something that is actionable or that we should overly read into. But it's awesome that you're noticing these things. So let's see if we get a return in volume in October. Back over to the YouTube from Cyril. I noticed that I do well in range days, but can struggle in the strong trend days. Almost the opposite of Kevin's question. What do you suggest how to improve performance on trend days? Sure. So you just have to recognize the types of adjustments that you need to make when the market is trending versus when the market is ranging. When we're going into trend days, you want to be much slower to book profit on with trend trades. You can expect to get a lot more P&L out of those moves, and that's why, for me at least, trend days tend to be much more profitable for me, just because, well, I can hold for much bigger moves that just aren't possible on range days. So so it depends a little bit on the type of trader you are. You know, if you're more of a mean reversion trader, then you probably don't do well on trend days, because on the range days, it's like today. On range days, every time it looks like the market's going to break out, it fails, and every time the market looks like it's going to break down, it goes up and fails. So if you're a counter trend, trader, if you like to take the opposite side of moves, you're coming in and you're shorting when the market's looking good and you're making money on it. Whereas if today happened to be a trend day, we would have broken out through some of these levels and never looked back. So if you're trying to short those up moves or buy those down moves, you're getting smoked on your counter trend trades. And on top of that, if you trade with the trend and with the direction of the market, and the other thing you have to recognize is that your potential for profit increases dramatically. So if you're the type of trader who is just always taking those quick singles and doubles, and you get the quick move in you're long, and you get this quick move in your direction at 10-20 to highs, you're like, all right, great, I'm long, I'm out, I made some money, I'm done. That works great on a day like today, and saves you money when this market pulls back. If it's a trend day and you're out of your position here at 10-20 in your long position, and it becomes a trend day and the SPYs go up to 488 today, you just left a boatload of money on the table. So I think, and I'm seeing a little bit out of what you're saying, David, on the corner of my eye, and with Kevin's question, with Cyril's question, for most of us, you will probably find that you do better on certain types of trading days. But the reason why you do better on those types of trading days is because of the strategies and the style that you've created yourself, and your inability to adjust to a change on a specific day, which is not necessarily meant to be an insult. You need to make the adjustment to change the approach on the day where you feel you have a higher probability of it being a trend day. Going back to Kevin's question about how do we analyze whether or not there's a higher probability of a trend day, what do we say? There could be a technical reason, there could be a fundamental reason, and market dynamics also play a role. So you want to be asking yourself, again, as part of your morning research, well, what is more likely that today will be? And then that's how you adjust your game plan. Because if today is a range day, if that's the higher probability, and again, I'm just making up a random example, you're long, then yeah, you want to be able to get out of the majority of your position into this little boost at 10:20 a.m. to highs. If today is a trend day and you're long, you want to be having sold out 10% of your position, or maybe 50% of your position to cover the risk, same deal, but then beyond that, being super, super greedy to see if you can get the continuation to 488. And for me personally, I find that I make much more on those trend continuation days, and I think that there's more profit potential on those trend continuation days, because you could hold that 1,000 shares of whatever, or 1,000 shares of Qs in this case, and if that's the 50% of your position that you're holding, and you get an extra $4 on it, it's $4,000. you're not going to get that $4,000 on these types of days where you just get that quick little move up and then you're out. You don't have that P&L potential. But again, those trend momentum continuation days happen much less often. So it's about identifying the possibility of if today can be that day. From David L in the VTF, I do worse on trend days and better on range days since the risk is better defined. I do agree there's more reward on trend days though, but need to improve on identifying whether a momentum breakout will hold or eventually fail. Yep, exactly. Back to the YouTube from T Squared. He's just thanking Tate for a great question. From Cyril, IWM break of the Friday, low of the day with a retest and going to 220 was a good trade today. Yeah, the IWM was super relatively weak. I for whatever reason, was just more focused on the Qs, probably because I'm in a position in T-Triple-Q and in a position in NVIDIA. But yeah, the IWM is where there was actually movement today. So you are looking at the break of Friday's lows, basically. You tried it off the open, held it, gave you a lower high, retested it, broke, and gave continuation. Yeah, good stuff. Yeah, so Uvixi Bull back on Palantir is thinking about selling puts on dips in Palantir while he waits. That's actually been a strategy that I've also been implementing on stocks that I like, that I get out of. That's what I did in Alibaba last week. I'm super bullish on these Chinese names right now. That's what I did in Alibaba last week. I sold calls. No, I didn't. I sold puts. All right. Monday morning. Monday evening. See? I don't even know what time it is. I sold puts in Baba last week for the same thought process. I didn't want to jump back in the stock necessarily at those prices, but I didn't mind getting them at certain lower prices if the stock went down, but I could create some cash flow for myself if it didn't. So I sold some naked puts. From Zahor in the VTF, SMMT was a perfect example of stocks being extended from the 21 EMA and due for a pullback, comparing this to, say, APP, which is super extended, or Carvana, which is also pretty extended. Can you explain a bit what may happen on this TOE stocks based on the technical? Don't really understand the last part of your question. But so look, first thing we got to remember is that momentum is an incredibly strong dynamic for markets. So stocks that look extended can become more extended. Momentum is what creates extension. That can't last forever. Eventually you have to have some degree of a correction in the market. Sorry, I briefly lost my train of thought. Eventually, you have to have some degree of correction on these extended stocks. It can happen through time, it can happen through price. But this APP in particular, there's a very wide range between this 8 and 21 EMA. So that just means that there's a good chance that when the 8 EMA catches up to the base of price action here, or it pulls back to the 8 EMA, that's not enough. That you'll need some sort of deeper correction to allow this 21 EMA to catch up a little bit further. So we can take that as it comes. But so far it's correcting through time. You have an inside day in this APP, so you can look for the inside and down to start to correct some of that extension further if it triggers tomorrow. What else? From Cyril, if several previous days were range days, it's more probable that the next day will be a range day too, but when it breaks into the trend, that's what can take me off guard. I would almost argue the opposite, that the more trend days in a row you get, the higher the probability that the more range days in a row you get, the higher the probability that the next day becomes a trend day. And that's just because what you're describing on range day after range day is some sort of tightening pattern. And markets work in series. of expansion and contraction movements over time. So the longer you're in a contraction movement, the closer you're probably getting to an expansionary movement. And then that's where your technicals come in. You pay attention to where those technical breaks can actually occur that are the technical catalyst that leads to a re-expansion movement, especially when that can be coupled with news. Today I saw the Qs in the IWM having negative correlation again. Is that caused by gamma, or are there some other mechanics at play? I didn't notice that, but typically that dispersion trade comes in when we're seeing those very high levels of gamma like we were seeing in July. But it shouldn't necessarily be the case right after an Opex in the same way, though it can be, especially because it was. From Kevin, also Mondays have been surprisingly semi-strong days to one side or the other in the past month or two. It's not a trend, but they give you that move 50 to 70 points in the futures. Came in expected some of that today. Okay. From Brad in the YouTube, he maybe already talked about this, but does NVIDIA look poised to go on the daily chart to you? It looks ready to go tomorrow or the next day. Let's take a look at NVIDIA. So NVIDIA is in a very tight, very neutral consolidation. This is a very neutral pattern here. Big picture, it's bullish. If you want to get very, very big picture on it, it's bullish. But this is a big wedge. This is a multi-month wedge tightening pattern that's building out, and it's trading at the midpoint of that. Because the big picture trend is bullish, there is a higher probability that that breaks up than breaks down, but I wouldn't be surprised on this breaking necessarily in either direction. And while a break of the 120 level is your trigger for this thing to go, I would also argue that the stock has traded very relatively weak these last several days. The Qs, broke out Thursday of last week and have held in ever since. And NVIDIA did not break out Thursday of last week. It stayed in range, stayed under 120, and has been fairly relatively weak. So this pattern here with this big picture trend means higher rather than lower. The relative weakness means lower rather than higher. It's a very symmetrical wedge. So this is a pattern that can really break in either direction. So I would say know your levels on both sides. I'm actually still short the stock off that relative weakness. But 120 is potentially setting up for a big upside breakout that you can pay attention to. Whereas if, and this keeps being an if, that hasn't come out to play, if any of that seasonality weakness can hit this market and cause the SPYs or Qs to fail, I bet that it's led lower by NVIDIA losing 115. So that's what I'm short for. I'm not short very big. I'm short small. But I'm short, looking for that move, and 115 and 120 are the most immediate spots that I'm paying attention to for a breakdown or for a breakup. Appreciate the question, Brad. Welcome to the YouTube. Not sure I've seen you in here before. All right, gang. I think that covers it for today. I hope everyone had a good day. Let's see if tomorrow can be a little bit more exciting. If you're on YouTube, give me the thumbs up. Have a wonderful night. I'll see you all then.